and a very warm welcome to all the viewers for this special panel discussion titled Is India Decoupled from Global Slowdown with our highly respected set of panelists. Before I introduce the viewers with all our distinguished panelists of this afternoon, let me take a moment to give a backdrop of this panel discussion and why we feel that this particular topic titled Is India Decoupled from Global Slowdown needs detailed discussion and deliberations. As you all know that today we are living in an era of extreme uncertainties and the medium-term growth forecast of the global economy look extremely bleak and hints towards a polycrisis on a global magnitude. The IMF predicts that 1/3 of the global economy is going into recession this year or the next. On one hand, the lingering COVID-19 has stalled the activities in some of the economies, particularly in China, leading to slowdown. Additionally, in China, the property sector, which accounts for a major portion of economic activities, is weakening. On the other hand, supply-side disruptions resulting from Russia-Ukraine war that started as early as February this year looks to have no end in sight, has caused severe energy crisis in Europe, which led to sharp increase in cost of living and dampening economic sentiment of the region. Inflation increased to multi-decadal high levels in many parts of the globe, and to counter this inflation, central banks across geographies have been tightening policy rates aggressively, resulting into abrupt reversal of capital from emerging economies, depreciation of their currencies, and increased volatilities. India, on the other hand, as IMF Managing Director has recently described, and I am quoting, deserves to be called a bright spot on this otherwise dark horizon because it has been a fast-growing economy even during these difficult times. But most importantly, this growth is underpinned by structural reforms, unquote. So real GDP growth of India remained resilient and grew by 6.3% in Q2 of the current fiscal year, and most of the agencies are forecasting a real GDP growth between 6.8 to 7% in this fiscal and next fiscal about 6.2 to 6.5. Now, with this backdrop, let me introduce our distinguished panelists. Mr. D.K. Joshi, Chief Economist, CRISIL, Dr. Shubhada M. Rao, Founder, QuantEco Research, Dr. Sachchidanand Shukla, Chief Economist, Mahindra & Mahindra, and Mr. Samin Narang, Head of Economic Research at ICICI Bank. A warm welcome to all our panelists. So let us start the discussion with the opening remarks from our panelists now without delay. So first, I'd like to come to Mr. Joshi and ask him his take on global economic outlook and how far this apprehension of a global recession is true. Mr. Joshi, please.
Well, thank you very much, Sudarshan, for having me here. It's a pleasure to be here. So I think clearly the global economy is slowing down much faster than was expected earlier. And this slowdown is largely coming from the advanced countries. The US, Eurozone, I think, which account for a large part of the world's GDP. China is also slowing, but I think it's slowing in 2022. In 23, it is supposed to move up. So this recession issue is largely limited to what happens in Eurozone and US. US is a classic case of overheating where central bank is trying to engineer a soft landing. But Europe, on the other hand, is energy dependent, unlike the US. So it is getting hit both from high inflation as well as lack of energy or reduced supply of energy is impacting its production process to some extent, or is going to do that in the coming year. So I think this will lead to a slowdown in the world economy. I won't call it a global recession, but I think the guidance that we are giving is that the risks to any forecast are currently tilted to the downside. Now the issue is how does this spill over to us? So if you were to do a very simple exercise where you just plot the GDP growth of India with the GDP growth of advanced countries, let's say 4 decades, what you will notice is that in the last 2 decades or so, the growth cycles of India and advanced countries have got remarkably synchronized. I think every downturn in advanced countries is also accompanied by a slowdown in India. And I think the reason is obvious. We have got more interconnected. I think since your program is called decoupled. So I think in that sense, in the short term, there's no decoupling. Actually, we are more interconnected. Exports as a percentage of GDP, financial flows as a percentage of GDP, all those have significantly gone up. So leading to synchronity of growth cycles. And I think what that means for next year is that the global or the advanced country slowdown is also going to spill over to us. It's already visible. I think if you look at exports have been slowing down. They registered negative growth in the month of October. And the prospects, I think, for next year are also not good, because the World Trade Organization says that the trade growth is going to slow down perceptibly in the next calendar year. So all that is going to spill over to us. And I think that so that is one channel. The other channels are financial channels, which we have experienced. I think capital volatility, exchange rate volatility. I think all those things are connected to what happens globally. So in the short run, we are interconnected. But I think on the positive side, if you look at the underlying trend, I think in the ups and downs in growth, what we find is the India's growth has been trending up and the advanced countries' growth has been trending down. So in overall, if you want to take a long-term call, then I think you are in a way, our long-term prospects are not related to the slowdown that is going to happen in the advanced countries. So they are, in that sense, you can say they are divergent trends or decoupled from each other. So let me stop there. I think with that.
Okay. Thanks, Mr. Joshi. So you say that in the short run, the decoupling is not much. The growth downturn is synchronous. However, in the long run, India's strong fundamental differentiates it from the global slowdown. Yeah. Now, with this, let us move to Dr. Shukla. So, Dr. Shukla, I would like to go one step forward and know from you about the monetary policies, aggressive monetary policy that the global central banks are following. Do you think that this global inflation is more a supply-driven phenomenon than a demand pull, and aggressive tightening of interest rates will hurt growth more than cooling of inflation? Dr. Shukla.
So thank you, Sudarshan. It's a real pleasure to be here interacting with fellow panelists and all the people here. I think a very important question that you asked. And the way I look at this is that if 2022 was a difficult year with all the leading central banks, especially the US Fed, which is the marginal provider of liquidity to the rest of the world, right? I mean, if they've been so aggressive and they made that 75 the new 25, right? I mean, there was a point in time when they continued with these 75 basis points hikes. And if the presumption was if such aggressive rate hikes were needed, I do think that the logical follow-up of that is that 2023 is going to be worse, right? I mean, if one felt that aggressive rate hikes were needed to cool off inflation, I do think it will have an impact, a lagged impact on global growth and on these economies. So the way I summarize this is that if 2022 was a difficult year for the global economy, 2023 is going to be worse, because what you'll see is the lagged effect of this aggressive monetary tightening playing out on growth. Obviously, it will not be the same across, say, geographies, but nevertheless, when we talk about the global economy, I do believe that the worst is to follow in 2023. But like Mr. Joshi said, I think we've heard this line, not all storms come to disrupt our lives, some come to clear your path, right? Paulo Coelho has said that. And in that sense, what you'll see is that very, very differentiated impact. What I mean by that is, just look at the IMF forecast, for example, for the advanced economies for 2023. Now, the growth halved in 2022 vis-a-vis 21 in say, advanced economies, and it is forecast to halve again in 2023, right? So the point I'm making is, for the last 2 consecutive years, growth is actually halving each year in advanced economies. And at the same time, you look at the complete contrast in which it is in the emerging space. Emerging economies, there was a halving in 2022, but 2023 growth is likely to be, say, 30 basis points higher in the emerging or the developing cohort. So that is the distinction that I was trying to make. And it will definitely have some bit of impact on the demand side, on growth cooling off. And I think there are very, very divergent views. People are divided, forecasters are divided as to whether the US is going to see a recession or a slowdown. But the point is, more than a third of the global economy and the key economies, when I talk about the US, when I talk about the EU or China, growth is going to be much slower than what has been registered or what will get registered in 2022. So there is a definite slowdown that's happening, but it's not going to be uniform. Advanced economies are going to feel the pinch will be pinched much harder than the emerging and the developing cohort. Talking of India, I think, therefore, when you look at the rest of the world, we are in a much, much better space. Growth is going to be around 6% for next year. But the point to note is, if I compare India's growth in the previous, say, such cycles when global growth has slowed or there has been a recession, India's growth differential, GDP growth differential, during, say, the GFC, pre-GFC, GFC, and in the last decade, I think India is going to be maintaining that growth differential, which we saw in 2004, 2008. I mean, that sort of a growth differential, 4.5%, 5% growth differential vis-a-vis the advanced economies. So yes, while India's growth is also going to slow from 7 odd to 6 odd, the point I'm making is it will still be a standout and India will still be having a higher growth differential vis-a-vis some of these other countries, and that will have an impact on capital flows and the way India is going to be perceived in this backdrop, right? So the least dirty shirt or calm in the storm and phrases like that come from there. So I think that story will persist. Back to you.
Right. Interesting remarks from Dr. Shukla. Thanks. So now I'll move to Dr. Rao and I would ask her if she agrees with Mr. Joshi's statement that India is not so much decoupled from the global slowdown in the short run, and in the long run, however, India's growth fundamentals are strong. And also, additionally, I would like to ask her if the global inflation has already peaked out, and if not, when do you see the inflation moderating? In fact, just to give you a context, US inflation is moderated to 7.7% in October from September's print of 8.2%. However, Eurozone inflation was up at about 10.6% in October from 9.9% in September. Quite a diverse trend. Yeah, Dr. Rao, please.
Yeah, sure. To your earlier question of whether I concur with DK, quite entirely, because we ourselves believe that right since the time of 1990s, since India began to integrate at a better pace with global economy, clearly there has been synchronicity in terms of growth cycles. So, of course, India's base being small, India growth has outpaced the global growth, but the cycles have synchronized right until now. In the current, very recent phenomenon since the 2020s, since COVID and war hit us, definitely then the microscopic attention goes to how well are the macros performing in each of those regions. For India, definitely our macros are far better than the previous global crises in terms of our external sector vulnerability or even domestic inflation, while we definitely saw inflation coming close to 8% at its peak in the recent cycle, but it was predominantly on account of the imported component of inflation. Whereas now that the imported component of inflation has been easing, both from supply side shocks and commodity prices, coming off about 15 to 20% from the June peak. We have seen concomitantly the wholesale price indices and in turn the CPI also showing a downward trajectory. So macros have now begun to look even better. I would think that there are 2 or 3 things that we need to take into cognizance. One is that while we are, as Sachchidanand was also alluding to, there is certain debate whether US will get into recession or what are the regions or parts of the advanced economies that will perhaps look at a more probable recessionary scenario. I would say UK and Eurozone become the more probable candidates there to see a recession kind of situation right at the doorstep. Whereas US, we do see some strength in the domestic demand. You look at wage price pressures, you look at the high frequency data, non-farm payrolls, etc. All are pointing towards yet growth remaining resilient. So not too sure whether US will straight head into a recession in 2023 or will be a very, very soft and muted growth. One big difference is, unlike the preceding global crises that we saw before COVID and war, China used to be one of the largest shock absorbers in terms of, supporting global growth. This time around, since 2020s, I think China remains very, very conspicuously absent in playing the role of shock absorber because of the huge internal issues in terms of growth, their sectoral problems. Of course, COVID still continues to play out. So China has been a big absentee in supporting global recovery this time round. Taking all of these global dimensions and imaging them on India conditions, as I said, in the very recent phase, India, why does it appear that India has decoupled in the short run is perhaps, going back to my original point, that while we did see inflation spurt, but we are seeing some downdraft coming into inflation, though it still remains on a relatively sticky path, unlikely for us to see a 4%, at least not in the next fiscal year, and perhaps a larger part of the subsequent fiscal year as well. In terms of growth, the domestic demand is now showing up. Urban demand remains, definitely far better. What really is perhaps lagging are the 2 engines of growth. One is clearly the export side. While exports to GDP, we will continue to see correction, which will get well reflected in our current account balance to GDP ratios. The rural demand, though it is recovering, but it still remains a slow mover in terms of supporting growth. So what then remains in the pieces of growth drivers is investment. Government has been playing a very, very dominant role in reviving investment. If you look at the high frequency, numbers of capital spending by the government is spending more, maybe, 50% higher than what it was in the preceding 2 years, as of today, perhaps. What yet is to recover at a broad-based basis, though enablers are very much in place, is the broad-based recovery in the private capex cycle. Tax rates are low, capacity utilizations are high, balance sheets are cleaner on corporate and banking side. Then why is it that, there is still a bit of hesitancy in reviving the capital cycle and therefore a more sustainable growth? I think that those are the things that we need to perhaps probe deeper. Is it that there is a tentativeness or less of confidence in the growth path? PMIs tell you a different story, that India has actually begun to look better on many of the domestic orders, export orders, which doesn't perhaps exactly synchronize with the real data. We need to inspect why there is certain dichotomy in the PMI, the survey-based outlook, and the real numbers. But to summarize what I've said for last few minutes is, India definitely looks on a relative scale far better than where the global economy is positioned, but is a 6.8 or 7%, the consensus growth rate, good enough for India's size of population of 1.4 billion people? It's not. good enough. We are hanging in there. We are doing far better. But for employment generating growth, we obviously need to aspire and work towards even a higher growth of 7%, which unfortunately, given the global conditions, both of my colleagues have spoken about it, tightening conditions, etc., are not likely to get India back onto a 7% growth path, at least into the next fiscal year. So that's where I would like to stop in terms of the global dynamics and India's position there.
Thank you. Thank you. Very interesting remarks, Dr. Rao. Particularly, China used to be a shock absorber earlier in earlier slowdowns. I'll take this forward and go to Mr. Sameer Narang and seek his views on Chinese slowdown in particular. Recently, Sameer, you have released a note actually saying that China's slowdown is a combination of both structural as well as cyclical factors at play simultaneously. In this context, I'd like to ask you, what are the structural factors driving China's growth down, and how does slowdown in real estate that accounts for a significant portion of China's GDP impacting the economy and the sectors related to it? Over to you, Mr. Sameer.
Thank you, Sudarshan, for having me, and a very warm welcome to everyone. In terms of, I think fellow panelists have already covered a large ground, and I think Shubhada also spoke about China. So in case of China, yes, there are two parts to the slowdown, as you correctly spoke about. There is a structural factor as well as a cyclical factor. The structural factor emanate actually from the country's policy, particularly the inward turn taken by the country from a technological standpoint. What we have seen is that China's policies incrementally are not reliant so much on pushing exports as an engine of growth and reliance on international technology for pushing its growth. They've turned more inward in the last 10 years under the new president than they have than the regime that has been in place for the last 40 years, under which they have been integrating with the world economy. If you look at their trade to GDP ratio, that itself has come down by almost 20 percentage points. And the economy is much more reliant on domestic retail market, domestic investments, rather than foreign. The extent to which China is relying on its own investments for pushing into foreign shores is mostly from a lens of geopolitics and not for technology transfer as such. In terms of the second change that has happened in the policy is also to the extent that China doesn't even want so much of foreign capital to drive its growth engine. If you see the new listings for Chinese tech companies, some of the listings actually have been removed from the US financial markets, have actually moved to either Hong Kong or the local market. So under the new policy, China is actually looking more towards even relying only on domestic savings. It's a net generator of savings because it runs a current account surplus. So it can afford to do that. Not many countries are in a position to do that. For a country like India, we actually rely on foreign capital and technology a lot for driving our growth higher and to do the productivity catch up. The third part in terms of the policy change is in terms of the real estate cycle that you spoke about. In terms of the real estate cycle, 25% of China's GDP, direct and indirect, comes from real estate. If you could recall, Sudarshan, in India also we had a very similar problem at one point in time in which the developers were over leveraged. The developers were relying on consumers' hard-earned savings, and they were actually not putting that money back into the same project, but actually buying additional land and doing all sorts of things. Then we had RERA coming in, the industry got regularized, and in India today, stamp duty collections are growing at somewhere around 25 to 30% on a YOY basis. So I think China also is undergoing a similar change in its real estate cycle. Number of developers have defaulted. Real estate was one of the highest borrower in the dollar market. So most of the developers are out of the dollar market now. However, recently what we have seen in the last 4 to 6 weeks is a turn in the Chinese policies. They are again providing stimulus to the real estate sector. The developers which have been left remaining are actually the stronger ones, and the government is giving them credit support, credit enhancements to make sure that they are able to deliver their projects. Some of the projects which were funded by international financial institutions, they've been taken over by them, and they would do the needful and finish them off. So I would say that structurally, yes, China has taken a very different turn in its policies. So its growth structurally will slow down from those 6 to 8% we have seen earlier to perhaps 4 to 5% going ahead. But this year's growth of around about 3.5% is truly a lower number on the lower side, also because of its COVID zero policy, which is also being reversed as we speak. Even in Hong Kong, which is the harbinger of how the Chinese policies are likely to look on COVID, we are seeing additionally a lot of opening up that has happened. And we do foresee a similar opening up perhaps happening in China when the political transition is complete by April. So what you would see is that structurally China will grow at 4.5 to 5% or 4 to 5% range. Maybe the earlier growth rates of 6 to 8% are not likely to come back. But we also have to acknowledge that Chinese economy is of a very big size now. It is maybe unrealistic to expect that economy to grow at 6 to 8%. Maybe 4 to 5% is also not bad number. So at that rate also, they'll add significantly more to global GDP than any other country in the world.
Right. Thanks. So effectively what you are saying, that Chinese economy cannot grow anymore at 7 or 8%. Yeah. Okay, thanks, Mr. Samir. So taking this forward, I'll go to Mr. Joshi and ask him his take on India's drivers of growth, basically. So he's spoken about, he's given us some glimpse like how India is not decoupled from the global economy. So I'd just like to ask Mr. Joshi, what do you think? What are the drivers of growth for Indian economy at this moment?
Well, I think this is the first year in last 3 years when the COVID did not functionally disrupt the economy, right? So that is why the services sector is seeing a very strong rebound, and that is going to likely to continue. Next year, maybe some of the pent-up demand could come down, but right now, services, contact-intensive services are one of the key drivers. The second driver of growth has been agriculture. I think despite climate-related hits, heat wave, subnormal or abnormal monsoon, not subnormal, I think despite that, agriculture output has grown very, very, it's a very strong output response from agriculture. Agriculture GDP is growing above the trend even this year till now. So that is, I think, another, and we shouldn't forget that it does contribute about 17-18% to GDP and also supports a large part of the population. I think beyond this, I think the government's focus on infrastructure creation also is supposed to have a higher multiplier effect on the economy. So that is also in a way playing out, particularly of the central government. States are a little laggard in that. Consumption has picked up though in a lopsided manner, but I think for certain categories of goods, I think the consumption momentum is quite strong. So I think these are broadly, I think from a macro perspective, the drivers of growth. The inherent strengths of the economy currently, I think, which Shubhada had also talked about, are number one, I think the corporate, mid and large side corporate balance sheet are extremely healthy. The leverage is low. So they are in a position to absorb another shock because of the strength of their balance sheet, and also in a position to invest as and when the opportunity comes, the uncertainty reduces. So that is strength number one, which kind of cushions growth also. Strength number two is the banking sector. I think the financial sector is in a pretty decent position to lubricate the economy in a much better way, because you are in a phase where NPAs are low, banks are well capitalized, and so on and so forth. The third factor, which is actually permitting the government to do investments, is the remarkable rebound in tax collections post-COVID. And I think this is to do with the one, obviously nominal GDP growth is strong, so tax collections are strong, but the GST reforms have actually paid off. I mean, so that compliance has improved, and that is leading to a very strong rebound in taxes. So that is the reason why I think despite such a bloated subsidy bill, you could finance investments. So I think these are some of the strengths which are helping cushion the blow. I mean, that is why I think if you did not have them, then you would be more vulnerable. I mean, and rupee, also one of the reasons why rupee has remained reasonably stable is, of course, intervention from the central bank, but also the fact that there are some strong fundamentals which the investor cannot ignore for long.
Right, right. Thanks, Mr. Joshi. I'll go to Dr. Shukla and ask him actually. So, Mr. Joshi has spoken about the drivers of growth. However, I'm sure there are some challenges also that the economy is facing, particularly on the rural segments. So, Dr. Shukla, if you can just highlight the challenges that Indian economy facing. Of course, the spillover impact from the global headwind is there. However, on top of that, if there is something like on the domestic front that you think the headwinds that India is facing. Yeah, over to you, Dr. Shukla.
Thanks, Sudarshan. I think in this talk about India being, say, within the top 5, going to the top 3 and things like that, and also our increasing global heft in the global economy, I mean, the G20 presidentship, etc. I think one thing that we need to look at is our per capita incomes, which is the purchasing power in general for the population. I think if you look at it granularly, there are multiple states where there is a deterioration, and these include some of the large states. I don't want to be naming them. But the point is, we need to have a holistic assessment of the economy. So yes, on an aggregate basis, country as a whole, we are definitely doing a lot better. And like I mentioned, this is a time wherein India is going to stand out based on the growth rate that we have, whereas everybody else is struggling for barely 1% or 2% growth. But at the same time, what this does is the low purchasing power that you have, or the lower nominal incomes that you have for the average population, does play out in a negative way if the corrective measures are not done. So, for example, couple of things that I see as a challenge going forward, and I'm not talking about just the next 12 months. I think we need to really handle death better in the sense I'm talking about the IBC, right? For example, we have spoken about how deleveraging has happened, how banking balance sheets are better, but India Inc. The Indian system needs to learn to deal with death better. We need to allow some exits, whether it is for corporates or whether it is for people to be able to move from less productive segments to more productive segments, right? So we need to plan and execute these exits better, whether it is for a corporate or for a general person. We need to make geography history. For example, I'm talking about the labor reforms, Gati Shakti, right? And all of these, the logistics reforms, it's well documented. Everybody really knows how these costs are way beyond the global averages or norms. And I think we need to be able to learn to do this better. So learn to deal with death, learn to do more with less, make geography history. You also spoke about the rural economy. I think there are things that are beginning to turn on the rural side. For example, the terms of trade are beginning to move in a way which is beneficial to the farmer. Inflation rates have come off a little bit. And I think if this sustains, the terms of trade are going to be better. We've seen the Rabi crop really, the acreage really improving. Mandi arrivals have gone up. So there are things that are changing for the better. But I think there are multiple things that we can do better. Productivity, for example, through more formalization, industrialization, financialization, urbanization, and a lot of these structural reforms. And the last bit, Sudarshan, is I think we haven't really had success with the export story. So remember the India of the golden old days. I think we need to really learn to entrench with the global GVCs. We have some pockets of success. I mean, you've seen these mobile phones and some indications of very, very few examples. But I think as a country as a whole, we need to be learning to be more productive and also be able to export more. So we've tried multiple things over the last several decades. But I think we need to to really crack this puzzle on how to be more competitive, how to export more. So I'll probably stop there and just mind you, what I just spoke about is more for the medium to long term, the India story, rather than just the next 12 odd months.
Right. Yeah. Thanks, Dr. Shukla. So I'll move to Mr. Narang. And so, Mr. Samir, you had done a very interesting study actually a few months back where you had shown that how the actual output of India during COVID period vis-a-vis its potential output of India, the gap actually increased significantly during COVID period, and subsequently the gap is converging. So I would like to ask you, when you think that the gap is actually closing, that is one thing. And secondly, what are the factors that are needed actually to, close this gap? Yeah, over to you, Mr. Samir.
Thanks, Sudarshan. Yes, you're absolutely right. So I think if you look at from the supply side, the biggest hit during the COVID period was to the services sector of the economy. And if you ask anybody which sector perhaps is doing the best right now, it's the services sector. But in particular, the contact intensive sector, which is travel, trade, tourism. I think India is likely, so what the government of India has done over the last couple of years is that the number of airports have doubled in India. And, this is going to unleash a lot of travel within the country. So that's a more structural side. You will see growth, which is probably running into the next few, into 5 or 10 or 15 years, because as the airport infrastructure develops, you will continue to see more people coming into the country. Both domestic travel and global travel will increase. If you see over the last 20 years, India's market share in global travel has actually quadrupled. So it was less than 0.5%. Now it's 1.8% or thereabout. This is pre-COVID. Now, with the infrastructure that is shaping up, perhaps you will see this number actually going up materially. So coming back to the potential output and correlating it with the government, built up in infrastructure, you're likely to see this output gap perhaps closing somewhere in the next year, perhaps, into into Q2 or Q3 of next year. That is when you are likely to see the gap closing materially. And you have widespread signs of, domestic revival, be it credit growth, which is running at 18%, which is the decadal high. You are also looking at, the built up in activity also from the government's capex side. The only laggard, which is not going to be, or probably now, which is going to come up, which was not the case during COVID, was exports. So exports was perhaps booming earlier, and now they are likely to be a drag on growth rather than, a push over into growth.
Okay, great. Thanks, Amir. So with this, now let me move to Dr. Rao and take her back to her last answer, where she said that private capex is yet to pick up. So, Dr. Rao, I'd like to ask you, what are the reasons the private capex is not picking up, given the fact that now corporates have deleveraged, the banks' NPAs have cleaned? And also, secondly, I would like to ask you further what Dr. Shukla had also mentioned, that some of the states' capex have not still picked up. While the central government has been doing heavy lifting with regard to capex spending, do you think that states also need to, when they are going to improve their capex? This is given the fact that the union government in the previous budget had announced that interest-free loan of 1 trillion to the state governments for 50 years. So yeah, over to you, Dr. Rao.
Yeah, so coming to your first question of when the private capex at a more broad-based level will start. And the reason I smiled was, yesterday I attended one of the events where precisely this question was asked of most of the stalwarts industry captains. And the answer still remained elusive. There wasn't any concrete answer as to why specifically the private capex is still not picking up in a more perceptible manner. But the broad indications in an indirect manner that one could infer were that the world still remains uncertain. Domestic capacities, while clearly are running close to, in some of the sectors, their capacity utilization is close to 80%. Even those sectors are not triggering a fresh additional capex. And the reason was there still prevails a fair degree of uncertainty and volatility from across the shores. Now, that itself tells you how well integrated perhaps we are today in India's economy, that you have to take largely global cues for your domestic capacity expansions. The second element that I would believe is, in some of the sectors, we have seen improved productivity. So productivity improvement has actually perhaps deferred the immediate demand for capex cycles to start in a more broad-based manner. The third aspect would be, why is it that for last 2 years, the government pump priming or the growth in capex on the government side has not spilled over in as many sectors as in the private sector for those sectors? Perhaps the reason is, there still remains a mismatch between exactly the point that you brought out of center and states. While the center has spearheaded in its capex disbursements and utilization, the states are still lagging behind despite having a comfortable position. In an analysis, if you look at the biggest industrialized states and states which lead in manufacturing, we haven't seen those states get into state-sponsored capex in a way that they should have, with finance position not as adverse as it may seem to be. So I would think that the crux of the matter here is still a lopsided demand recovery that continues to be evident in our economy. We have seen, as DK also pointed out and Sachchidanand also pointed out, that we still have pockets of concern that growth continues to remain absent, and perhaps growth being on a stronger recovery path, maybe a year and beyond away. I think that perhaps is slowing down the actual capex execution at broad-based sectors. The typical multipliers that we could potentially see, I would see coming from hard infrastructure sectors or even railways. Railways are doing significantly and phenomenally better in terms of adding capacities. And if you look at the pipeline development or from railway sectors coming on board, I think there the spillover, positive spillover, should start kicking in very quickly. The roads we have seen definitely, spilling over onto cement and steel consumption and so on. But overall, I think what continues to perhaps stall back a very strong recovery in private capex is the global conditions impinging more on the domestic impulses.
Okay, thanks. Now, moving on to inflation. I'd ask Mr. Joshi his take on inflation. So what do you feel like inflation trajectory for India? It has been above 7% in Q2. However, it has eased a bit to 6.8% in October. WPI was also in double digit, though it has come down off a little bit. So where do you see the inflation trajectory given the higher commodity prices globally? And despite the fact that global commodity prices have also corrected, but India's inflation trajectory looks on the higher side. What is your take, sir?
In the base case, we do expect inflation to come down. If you want the numbers, I think our forecast for the October to December quarter is 6.7, and the next quarter is 5.9, and for the next fiscal year is 5%. So that is the baseline trajectory in terms of hard numbers. Now the dynamics are interesting. I think that's where the interesting part is. If you look at food inflation, which has been a bugbear for some time, food inflation is, I think the indications are that it will come down because your Rabi sowing is very good. You have good soil moisture. The reservoir levels are very, very comfortable, I think, and sowing is much above what it was last year, particularly for wheat, where you are seeing very high inflation. So I think if weather doesn't play a spoil sport, which it did, I think, earlier this year, I think then we are headed for lower food inflation. That's what I would say. So I think base case is lower food inflation. Fuel, I think, is a story where I think which is completely fraught with uncertainty. the global crude prices have come down, but I think the risk is always there that they could flare up because of geopolitics. So I think that you have to keep your fingers crossed. Then I think the most sticky part is core inflation, which I think the the RBI governor also alluded to. What we do is we look at input prices versus output prices. What we find is that input prices have come down pretty sharply, but the output prices are flat. So clearly, I think the pass through from somewhat lower input prices to the final product is not there, because companies are also trying to protect their margins. And we see this tendency continuing. On top of that, service rebound is ensuring that the services inflation remains high. So the core inflation becomes very sticky. And by raising interest rates, RBI is trying to check the persistence of core inflation, or to reduce the persistence of core inflation, because it can't control fuel and food prices directly. So I think that how it plays out is going to be very critical to watch. So I think on inflation front, there is a general comfort, but as I think it was very obvious from the most recent monetary policy, there is a huge amount of uncertainty around anything you say right now.
Yeah.
Okay. Thanks, Mr. Joshi. So uncertainty prevails on inflation. So with this, I'd come to Dr. Shukla, and I'll ask you, so since you do a lot of research on rural economy, so I'd ask you, given this higher inflation, how the rural consumption pattern and the demand is playing out? Because like the overall CPI inflation is on the one hand high. However, the rural CPI in particular continues to be even higher than the overall CPI. So, Dr. Shukla, what is your take on that?
You're right, Sudarshan. I did mention the adverse terms of trade for the farm side. It has been so for more than a year now. However, last couple of months, we have seen this narrowing down, especially with the global commodity prices coming off. And one of the biggest costs for the farmers happens to be diesel price and fertilizers, right? Apart from the manpower cost that we look at. Both of these, there has been some bit of relief for the farm side. And therefore, the terms of trade is beginning to move in favorable direction. At the same time, what is really important is there are two things that you need to look at. One is the ability of the rural side, including the farmers, to be able to earn and therefore spend. And there, I think there has been a problem so far with erratic rainfalls, excess rainfalls in certain pockets, and that had created problems with cash flows, right? But when you look at the willingness of the farm side to be able to spend more, what they're going to do is look at how the Rabi acreage has gone so far, mandi arrivals, the prices, for example, for some of these mandi prices for these the output, and also there is a non-farm component which is government spending, right? So if you look at the government spending bit, it's begun to move up. I mean, we do monitor spending, which is agriculture, rural development, and other social expenditure of the government. And I must tell you that there is no pan-India average that really works. We need to monitor it state-wise and region-wise. That works much better, because otherwise, I mean, the generic take on the farm side or the rural side, which we tend to speak about in forums like these, or generally doesn't really work. You need to look at it state-wise or state-specific. And I can tell you that the spending bit has begun to move up. On the other side, whether the government has the wherewithal to be able to spend, we do see some bit of relief over there. One major problem that was impacting the non-farm activities, income and expenditure was the erraticity of government spending, right? So the government spending across agricultural schemes, across rural development schemes has been very, very erratic. And going forward, we do see a semblance of synchronous spending that's begun to happen. If this persists, along with the ability and the willingness factors that I spoke about, I do think that the rural economy may see some recovery going forward. So we remain hopeful of that recovery. provided the erraticity in government spending evens out.
Okay, yeah. Thanks, Dr. Shukla. So with this, I'd move to Dr. Rao and ask her a couple of questions on monetary policy. So Dr. Rao, firstly, what is your take on the last monetary policy? You think it was hawkish or dovish? And secondly, now that MPC reduced the quantum of rate hike out to 35 basis points, where do you see the terminal rate hike in this rate hiking cycle? Over to you, Dr. Rao.
Yeah, thanks, Sudarshan. I think, as far as the monetary policy direction is concerned, we're probably going to see one more rate hike. That would be in February of 25 basis points. We were of the view earlier, before this policy announcement came by, that probably RBI would stop at 625 and pause to see the accelerated tightening pace that it had executed since May, in effect since April, actually, because of the change in, the lower end of the corridor. So we were of the view that probably RBI would pause after this, but, listening to the commentary of the governor and the team, one would believe that the focus is clearly on attending to the stickiness in core inflation and the second order impact. So with that kind of a commentary, obviously, we have added one more rate hike, that is of 25 basis points. And in our opinion, that could be the terminal rate, that is 6.5, which would happen in February of 23. And what was your second question? I'm sorry, I sort of lost track of that.
No, I was asking, what was your read of this last monetary policy?
Yeah.
Do you think it was hawkish, dovish? What is the take on that?
I normally don't like to stick to a hawkish and dovish tags, because it is perception, but yes, if I were to attach a market perception to it, definitely market expected it to be less hawkish than it sounded, because somewhere the terms used of breaking the back of core, and going on for long. In terms of pace of hikes, obviously, the moment you also see Fed leading the design of longer rate hikes of lower magnitude, something similar was getting expected even this time round from RBI, that we were unlikely to see a 50 basis point rate hike to continue as it had done over the previous three readings. And it would, bring back a smaller dose of hike, also in consonance with, the inflation trajectory that it is projecting. Going forward, we do see second half, the inflation, headline CPI inflation coming well within the band of the upper end of the band, which is 6%. So somewhere we will see towards the fourth quarter, inflation coming close to or lower in terms of headline CPI, somewhere around 5.8 or 5.9. And going forward, spilling into the next fiscal year, we could see it trending even lower. Supply side is getting better. Commodity prices are easing globally. More importantly, the imported component. If you hear Dr. Patra's commentary, what factors would be paid attention to. It's clearly the stickiness in core, which is essentially coming from services. Services have been displaying a very, very sticky nature for past about 12 to 18 months reading now. We have seen imported component of inflation spilling over, and of course the demand side getting better. So all of these put together, we will see attention and vigil continuing over the inflation trajectory going forward. Overall, I would believe that globally also we are going to see inflation slowing from these past peaks very rapidly. I'm sticking my neck out, I know, but I believe that, supply side is going to start getting better. and with kind of impact and spillover of hastened global tightening, will have some kind of demand cooling. Mortgages are going high, mortgage costs are going high, food and energy prices are continuing to remain elevated. And this becomes more pertinent for Eurozone and UK, which are more vulnerable to these prices. But even in US, energy prices, mortgage costs are going up. So somewhere all of these have to begin to impact the demand side of the economy as well. So we will see inflation trajectory trending lower by a fair margin for the advanced economies also. So on inflation, I think, and monetary policy, the comfort is that perhaps the accelerated pace of tightening from here on from all central banks will go into lower magnitude of tightening, while the terminal rate from the Fed is much higher, as announced in the December review. But will it be executed through a 75 bips hike? Obviously not, as was commented by Powell. It would be 50 and perhaps subsequently 25. In fact, the markets are pricing in a pivot of Fed policy sometime in the end of 23. And people are actually, market participants are actually looking at rate cuts coming in from advanced economies.
Okay, thank you. There we are. So with this, I will move to Mr. Narang with the last question in the interest of time. So Mr. Narang, question on liquidity actually. So the RBI has been mopping up excess liquidity and there was an eventual deficit in the system liquidity earlier. But now again, the system liquidity has gone into surplus and today it was about 1.4 trillion. So what, according to you, what are the major driving factors of this liquidity going forward? And what will be the level of liquidity the RBI will be comfortable going ahead? Over to you, Mr. Narang.
So, Sudarshan, the key driver of the liquidity decline or reduction this year, there have been two actually, largely speaking, three actually, largely speaking. One would be the FX intervention that the RBI has taken during the year. That would have contributed the most towards reduction in the overall liquidity. The second one is the CRR build-up, because there was a CRR increase as well as the banks actually do have to put up the extra cash for every rupee of deposit that comes into the RBI. And the third one is essentially the demand for currency. Amongst all three, actually, the softest that you are seeing is the demand for currency. This year, the demand for currency is perhaps far lower than one would have thought of. I mean, we are talking about nominal GDP growing in that, 17-18% mark, but the demand for currency is actually half of it in terms of YOY increase. And what explains that is digital platforms that we have built, particularly the UPI transactions. You, me, all of us in the panel and the viewers, I mean, I even pay 40 rupees, 20 rupees. I don't even carry my wallet so many times now. So that just tells you that, the demand for currency is coming down. And that's positive because the currency leakage actually comes down. But I would see the ordering is that. And your second question is what is going forward, where the liquidity would be and what are the drivers? I think, Sudarshan, what has changed in the last few weeks are the FII inflows. What we had seen was very large outflows, very large FX intervention by the central bank. Also, the central bank has run down its forward book quite a bit. So instead of using cash dollars, it is utilizing the forward book and doing the transaction to make sure that it doesn't have to supply cash dollar immediately into the market, or it does an equivalent amount of swap to ensure that the liquidity is neutralized for its FX intervention. However, you would see perhaps continuing demand for dollars, but at the margin, intervention is going to be far lower than what we have seen in the last couple of months. That is one. The second is that government spending is going to be very, very high. The state governments are still running a significant amount of cash surplus. They're not borrowing as much, so they probably will come out and spend. That will put more liquidity into the system. And the economy does require higher liquidity, as you can see the wedge between deposit and credit growth. So system does require higher liquidity. And so whatever extra liquidity which is available in certain parts of the economy, say with the government, will be provided to the economy. And at the margin, FX intervention will be lower. So on balance, when we look at these, both the forces, I would say a number around about 1 lakh crore is where you should ideally end in terms of overall liquidity. And next year, you perhaps can look at additional measures being taken by RBI to infuse liquidity into the system to sustain credit growth and provide liquidity for the overall economy. Because RBI has taken certain measures to absorb liquidity out of the system, and it has also done some more sales this year and not done any more purchase, which it had been doing earlier. So there are drivers which the RBI has in its control to inject liquidity next year.
Okay, great. Yeah, thanks, Mr. Narang. So, all right, with this, we'll now open the floor to the media for a few minutes. And if they have any question for the panelists, they can unmute themselves and ask one by one. All right, I think so. There is no question from the media side. So I'd like to thank you, everyone. With this, we have come to an end to what can be definitely said a very interesting session with our distinguished panelists.
There is one question, I think, Sudarshan.
Okay. Okay. Okay, with the Eurozone seeing recessionary pressure, will it be service sector see a boom? Will the service sector see a boom? Yeah, so I'd request any of the panelists to take this. Dr. Rao, would you like to take it?
Oh, for me? Okay.
Yeah.
I thought DK was answering.
Oh.
Well, I think will India's services sector see a boom with Eurozone seeing a recession? Difficult to exactly put a growth or a forecast trajectory basis Eurozone recession, because if you look at if you look at exports vis-a-vis domestic services, exports have remained very resilient. Services exports have remained very resilient. If you look at the past 8 months of numbers in this current fiscal year. In fact, I would say that it's almost a matching of merchandise deficit is equal to, net services exports. So it's almost even Stevens. So India's service exports haven't seen such a dramatic cutback. With Eurozone recession, perhaps India could see some room in making larger play in terms of services exports, business exports, software, and so may you have. But in terms of direct connect between Eurozone recession and then India's domestic services, doesn't seem to be a quick correlation, unless DK has some thoughts on it.
Yeah, Mr. Joshi, would you like to add?
Mute.
Mr. Joshi?
DK, you're on mute.
Is that okay now?
Yeah.
But what I was saying is that growth slowdown in Eurozone will spill over to us adversely. I think one is the tourist part, I think, but the services exports, I think the requirement will, in a recessionary environment, it does go down. I mean, and I think they, so it will have an impact. But I think US is more important player, I think, for those tech-related services than Eurozone. UK is a major consumer, so I think there is going to be an impact. I think there's no doubt about that. How much, I think I can't say that right now. It depends on the intensity of slowdown. See, Eurozone is in for, I mean, for a slightly longer period of pain than the US because it is energy dependent. So I think, so it will take time it will take, I mean, the pain from emitting from there will stay longer, I think, even for services, to some extent for services also. So I do see an adverse impact.
Okay, thank you.
And just to add, I mean, the services number that we have with respect to EU is smaller than what we do in terms of physical trade, right? So we have a $32 billion sort of a services number, whereas on goods we do about 50 billion plus, if I remember right. So I don't think we are going to be a major beneficiary of this. In any case, services is still much smaller as compared to what we do on the physical side with the European zone.
Merchandise trade is significantly higher than services.
Okay, I think one more question has come. I think this is the last question we're going to take. So this was that Mr. Joshi said that NPA are low, so our financial organizations are strong. However, low deposit rates is hampering credit growth. How can we tackle this situation? I think this is for you, Mr. Joshi.
Yeah, but I think the bankers can answer this much better. But my 2 cents on this is that the deposit rates need to go up. I mean, the depositors are getting short shifted right now. I think they have to. So you will see deposit rates which have been rising go up, and I think that's how you'll mobilize the resources. I think the point I was making is that I think this is not may not be such a big constraint. I think given that we're not talking of a boom in the economy, the point is that whenever I think the economy recovers, the financial sector is in a very healthy position to very quickly provide credit, I think.
Okay.
So that was my point.
Yeah, Mr. Sabi, would you like to add to this?
No, I think it's been covered well. So credit growth is running at a fairly good rate of 18-odd%, very broad based. Everything is doing well in terms of credit accretion. At the same time, deposit growth, yes, is at the lower end. But as of now, there was no need to raise deposit rates as well because the system was in surplus liquidity. Unless and until there is a binding constraint, you don't want to raise your costs or increase interest rates till such time you have surplus liquidity. As liquidity is drying up, you would see banks raising rates. Already in the wholesale markets, interest rates have gone up. In retail also, selectively banks are raising rates. So I think over time you would see the wedge coming down and you would see a situation which will actually is in balance. And on an overall basis, what we should look at is the credit deposit ratio. At the peak where system gets a little bit tighter is probably closer to 77, 78. We are far lower than that. So I think there is still enough liquidity in the system as a whole to drive credit growth. That is what we have seen. And going forward, interest rates are going up, which will ensure that the wedge is down.
Okay, thanks. So with this, we come to an end. So what we can definitely say a very interesting panel discussion. During the course of this conversation, we touched upon various important aspects of the global economy, their impact on India, India's own domestic outlook, drivers of growth, reforms, credits, and currencies as well. I'm sure this fascinating conversation will immensely benefit us. I thank all the panelists for joining us today and sharing their thoughts and providing analytical reasonings to support their views. Also, we thank all the viewers of the event and the media for joining us. A special thank to Mr. Gaurav Kumar, our founder and CEO, for providing us the opportunity to organize this event. Thank you, everyone, and hope to see you again. Thanks.
Thank you. Pleasure.
Thank you.
Thank you.
Access to capital.
Access to capital.
Access to capital
Is access to capital.
American is